Hello again. In the previous section, we were talking about building business relationships with the investors. Now we know the language you're using. Now we know what the investors want. Now we know how to look at investors as well. But the big question that hasn't been addressed yet is valuation. How do we value our business? There are several models for that. The discounted cash flow, the venture capital method, the scorecard method, the previous round method. We'll go into each one of those. So let's start off with the discounted cash flow method. It is basically a valuation method used to estimate the future cash flow of the company and work its way backwards to the time value of this cash flow today. The formula for the DCF is quite complicated, but it's very, very rarely used, and it's almost never used in early stage startups. Because the reality is estimating future cash flows for an early stage startup is very, very hard to do. It's just unrealistic. This is used more on later stage investments. It's used mainly for private equity type of investments, but it's also used for sometimes for like Series B type of investments as well, where now there's enough visibility to understand the cash flow, the future cash flow, and then you can work it backwards. So the more preferred and much more preferred method within the VC space is obviously the VC method. The venture capital method is a quick approach to valuation, and it basically builds on certain assumptions. And the nice thing about it, it's futuristic, it works things backward. So the starting point for any company is understanding how much revenue they will be generating within the coming period. So let's take an example and walk through it. Assuming you're building a company and you claim that, and you can justify that claim, that you're basically creating a revenue of $800,000 after 4 years. If we believe in this claim, then we will together decide on a multiple of that, and that becomes your valuation at that point. Let's assume it's a 10x, which means the value of your business after 4 years is $8 million. This 10x is more of a global standard. It differs from one market to the next. It differs from one maturity level to the next. It differs from one phase of the startup journey as well to the next. But let's for now, for the ease of calculation, assume it's a 10x. So now you're in good shape. Your business is valued at $8 million in 4 years. Yay! Well, it's not that much of a yay, because there's another factor, which is the IRR, which is how much the venture capital fund wants to make on you. So basically, if we're targeting that you double your business every year, that's 100% IRR, then let's work it backwards. So in year 4, your value is $8 million. Multiply that by half. So in year 3, your value is $4 million. In year 2, your value is $2 million. And today, your value is $1 million, or year 1. So basically, now we're evaluating your business in reality at a $1 million range. So it's not really 8 million as you had imagined, because this 8 million is in 4 years. If now you're raising $200,000, then basically we get 20% equity in this company. And this is how it works. So basically, just to summarize, the multiple, which is the 10x that we decided on, is called the multiple. The IRR is basically the multiple that we want to create as a VC or achieve as a VC per year, which in that case is 100%. And therefore, by returning backwards, we calculated your valuation as of today. This is a general practice that we take into consideration, but it is not the only practice. Let's see the other practices as well. We use the scorecard method. The scorecard method is basically a comparable method where we look at different companies at the same stage, more or less, doing the same thing, more or less, how much they are valuated at, and then we start comparing together. And basically what we do is assign points. So we look at, for example, strength of team. If your business is, if your team is stronger than the other companies, let's give this another 10% extra. Size of the opportunity, if you're attracting a smaller market size. So for example, a company that is at the same stage with the same product targeting the US will probably be evaluated at a much higher level than a company of that same product targeting Egypt, simply because the size of the opportunity there may be a lot higher. Or not. If you're targeting a certain segment in Egypt that is bigger than that in the US, then you would have a higher valuation on that particular point, or basically a higher score on that particular point. We look at things like competitive environment, how strong is your product or service? Did you IP it? If it's something that is very unique, that gives you extra score. The strategic relationships with partners. We've seen companies that have already created partnerships with fast-moving consumer multinational companies across the region. So we know the potential, even though it hasn't been achieved yet, but the potential is tremendous. We give that extra weight. How much funding? These are our question marks where we start comparing companies to each other and then say, okay, well, this company X was raising at that number within that market, was raising its round at a $10 million valuation. You just scored a bit less across several areas, so let's go for the 8 million. So this is one way of looking at it as well. The other way of looking at it is basically looking at the previous round basis. So if you're a company that was doing $300,000 in revenue and you raised back then at a valuation of $10 million, and now you're doing $600 million in revenue, then it only makes sense to raise at a valuation of $20 million. So if your revenue doubled, then the valuation would automatically double. It is not as straightforward as that. Because sometimes, for example, we expect the growth rate to slow down after a certain time. There are a lot of factors that go into that. You may have gotten into new verticals that are not growing as fast. So we take all that into consideration. So what really happens is we blend all that together. We look at previous round bases. We look at venture capital method. We use it. We use the comparable method. And then there's also a very personal part, which is a negotiation as well. It's how much are you raising and how much equity are you giving? This becomes part of the dialogue as well. And that becomes the basis for the valuation. To do that as well, we have to ensure that we are on top of the numbers. Because like we mentioned before, if we're talking about $800,000 in revenue by year 4, this all has to be justified, which means you have to have a very, very clear budget for that. So that will be covered in the coming section.